That's right. The financial industry does not play fair. They're out to get you, a piece of your income, your wealth, your life. And they're deploying all the tricks in the book to do that. Well, let's flip the game on them. Let's reveal some of the dirtiest tricks that the financial industry is playing, so it is you winning the money game, not them. And hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn not only to grow our wealth slow and steady, but the secret to having the most amazing hairline on the internet. I'm just kidding about that last part, my friends. There is no secret. It's just genetics, a lot of money spent on overpriced hair treatment, and a complete refusal to accept bad hair day. Alright, enough with the hair. Let's get into the real reason why you're here. The number one dirty trick the financial industry loves to play to make more money. Gamifying stock trading. Essentially making stock trading fun like a harmless game, so you take more unnecessary risk with your precious money. Most of us grew up playing games. Card games, board games, video games, etc. And most of them are great. We have fun times with our family and friends, and some we even learn new life skills. Strategy, communication, overcoming adversity. Thus, even after we've grown up, we still gravitate towards many of these games. We just love the feeling of leveling up, making progress, and winning. But the financial industry knows this too, and they figured out how to use that love of winning against us. What the financial industry is doing today is turning real money, your hard-earned money, into digital poker chips. They've wrapped serious investing in flashy graphics, dopamine-triggering sounds, and confetti animations. And it works. People start trading stocks not based on research, but because it feels exciting. It's like you're leveling up in a video game. Take Robinhood for example, the poster child for gamified investing. While they've toned it down after regulatory scrutiny, earlier versions of the app used to literally shoot digital confetti across the screen every time you place a trade. They've also used colorful graphics, achievement-like notifications, and free stock lotteries to reward new users and referrals, similar to opening a loot box in video games. Or look at apps that track your streaks for trading every day, encouraging you to keep playing the game just so that you don't break your progress. Some even offer badges, leaderboards, and push notifications, cheering you on to make your next move. These features might seem innocent, but they are not. They're carefully designed to make you engage more, to trade more, and ultimately take more risk. And at the end of the day, even if the trade goes south and you're left holding the bag, the financial industry still makes money, because they take cut of every transaction or profit off payment for order flow. Bottom line, understand that investing is not a game. It is you and your family's future. It is your life savings. It is your money. So be careful of platforms that gamify investing. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. The number two dirty trick the financial industry loves to play to make more money. Targeting financially vulnerable communities. This one gets me really riled up. In my previous life as a finance director, I used to make regular trips to South Los Angeles. Many of the clients that I served were located there. And for those of you who may not be familiar with this area, South LA is what some would call a rougher neighborhood, primarily due to the fact that it's been historically neglected and marginalized. And because of its reputation as an underserved neighborhood, it is home to some of the shadiest and predatory financial services. Payday lenders on every corner, title loan offices sandwiched between fast food joints, check cashing stores lit up like casinos, and every other block, billboards advertising guaranteed approval loans with sky-high interest rates and fine prints. It was clear who their target was. People who were struggling. People who didn't have access to traditional banking. People who were just trying to get by. These businesses were not there to help them. They were there to trap them into cycles of debt, dependency, and financial instability. The financial industry knows that when someone is desperate, they're more likely to take on unfavorable terms. So instead of offering real solutions, they slap a coat of neon paint on exploitative products and call it financial help. Come, I know you're having a hard time financially. We can help you. But the truth is that the only people they're helping are themselves. But if you ask me, I find it not only disturbing, but outright wrong. Alright, what's another trick that exploits the vulnerable? Let's get into that next. However, before we go on, I have an exciting announcement that I want to share with you. For the past year, I've been working on a very exciting project. Introducing the Financial Tortoise community, your ultimate roadmap to mastering your money, systematizing your finances, and securing your family's financial future. I created this community because I know firsthand how overwhelming personal finance and investing can be. In today's fast-paced world, you're bombarded with so much information when it comes to money. Get-rich-quick schemes, conflicting financial advice, and confusing investment strategies that make it harder, not easier, to know what actually works for building real wealth. This is where the Financial Tortoise community is different. Inside the community, you'll get a clear structured path to building lasting wealth. built around simplifying, systematizing, and optimizing your finances for the long term. No unnecessary complexity, no hype, just proven practical strategies that work. Plus, as a member, you'll have access to something truly special. One-on-one time with me. Direct personal support where you can ask your most important financial questions, get a personalized financial plan, and have the confidence to know that you're moving in the right direction. Whether you're confused about how to allocate your investments, overwhelmed by all the financial advice out there, or just want clarity on your next steps, I'll be there to guide you. But that's just the icing on the cake. On top of the one-on-one time with me, you get so much more when you join. Member exclusive courses. Step-by-step video lessons on developing the right money mindset, demystifying investing, automating your finances, minimizing taxes, and more. These courses are designed specifically for slow, steady, long-term wealth builders like you. Monthly live Q&A calls. Live group coaching sessions where we dive deep into key financial topics, answer your questions, and help you stay on track towards your goals. Private community forum. Connect with other like-minded, hard-working professionals. Share your wins, ask questions, and build relationships with people who are on the same slow and steady journey as you. Tools, templates, and resources. Access ready-to-use financial tools, templates, and resources built to simplify your decision-making and make managing your money easier. And instant access to all updates. Get immediate access to all new training, tools, and features as soon as they're released, with no extra charge or hidden fees. Every update is included as part of your membership. The Financial Tortoise community isn't just another program. It's a place to transform your financial future with intentionality and simplicity. Many have completely transformed their financial lives, and you can too. With the right guidance, a clear plan, and consistent action, lasting financial freedom is within your reach. You deserve it. But a quick heads up. To ensure that every member receives the best experience possible, I only open enrollment a few times a year. So if you want to be the first to know when the doors open again, make sure to join the waitlist today. Just head over to financialtortoise.com/community or click the link in the description below. And as a special bonus for joining the waitlist today, you'll receive a free special gift delivered straight to your inbox, automatically just for signing up. I would love to see you inside. Alright, with that said, let's get back to the video. The number 3 dirty trick the financial industry loves to play to make more money. Promoting buy now, pay later as financially savvy. These buy now, pay later services are marketed as not only a great way to get what you need right now, but also to do it in a financially savvy way. They frame it like it's a smart money move. Why pay all at once when you can keep more cash in your account? It sounds responsible, almost strategic. Phrases like zero interest or split your purchase into 4 easy payments make it seem like it's some kind of a financial life hack. And if you're an individual that is working hard to save money and get better with your finances, this sounds very attractive. I'm being smart with my money, right? But that's exactly the illusion. Behind the slick marketing and interest-free promises is just another form of consumer debt, wrapped in a prettier package. And because it doesn't feel like traditional debt, we tend to justify more purchases. Companies like Klarna, Afterpay, and Affirm make it feel completely normal to borrow money for a $30 t-shirt or a pair of headphones you probably don't even need. But here's the truth. It's just another form of debt. Our brain is tricked into thinking we're spending less when in reality we're spending more, often on things we wouldn't have bought in the first place. And the lenders, they're not offering this out of generosity. They make money when you miss a payment, when you pay late, or when retailers pay them a cut because you're now more likely to check out with extra items in your cart. It's a win for them, but a loss for your future self. Buy now, pay later is not financially savvy. It's financially slippery. What's another slippery trick that the financial industry loves to deploy? Number 4 dirty trick the financial industry loves to play to make more money. Pushing store credit cards at checkout for a big discount. You probably heard it before. You're at the register about to pay and the cashier asks, would you like to save 20% today by opening a store credit card? Target, Macy's, Best Buy, Kohl's, you name it. Almost every major retailer offers some version of this. And it's very tempting. I mean, who would want to save 20% instantly? But here's the catch. That 20% discount is a shiny bait. And one I'm embarrassed to admit, I've fallen for before as well. Hey, we all have our dark secrets, right? What they don't highlight is that many of these cards come with sky-high interest rates, often 25% or more. According to LendingTree, the average retail credit card APR is over 28%, much higher than a typical credit card. Even worse, opening multiple store cards can hurt your credit score. Each application dings your credit, and these cards usually come with pretty low limits, which can mess with your credit utilization ratio if you're not careful. The financial industry knows that most people do not read the fine print in the middle of a busy checkout line. They're counting on impulse and the appeal of an instant reward. So while it may feel like you're being smart and getting a deal, the truth is, unless you're ultra disciplined and pay it off immediately, you're just giving the credit card company another reason to celebrate. The number 5 dirty trick the financial industry loves to play to make more money. Selling financial products to children or teens. This is another one that gets me really riled up. 1, because I believe it is just so wrong. But 2, because I was one of those teens that fell hard for it. In my first week of college when I was 18 years old, I was one of those naive students that opened up my first credit card because not only were they offering a free t-shirt, they would give me a personalized credit card with my name and my proud school logo on it. I mean, how can I resist, right? What I didn't realize at the time was that this was not a gift, it was a trap. I had no income, no budgeting skills, and no real understanding of how credit cards worked. But that card made me feel like I did. It gave me the illusion of financial responsibility. And before I knew it, I had thousands of dollars in credit card debt and no plans on how to pay it off. And this is not just my story. It is a playbook. Credit card companies have been targeting college campuses for years, knowing full well that students are inexperienced with money. They offer freebies, campus pride, and even reward points just for signing up. Now, many of these blatant credit card practices have died down since the Credit Card Accountability, Responsibility, and Disclosure Act, aka CARD Act of 2009. However, the targeting of the young hasn't. Today, we have apps and financial platforms pitching investing accounts to teenagers. They use bright colors, fun images, and get-rich-young messaging to draw them in. Some even let teens buy fractional shares of stocks with just a few dollars. And no context, no education, just hype. Look, I'm all for financial literacy, but teaching young people about money should come with education first, not sales pitches disguised as empowerment. That is not only wrong, but I say dirty. However, the targeting of the unsuspecting doesn't just stop with the young. It continues well into our adulthood, which leads to the next dirty trick. The number 6 dirty trick the financial industry loves to play to make more money. Pushing risky assets to unsuspecting investors. This one is especially dangerous because it is often dressed up in polished marketing and impressive sounding terms like alternative investments or institutional grade opportunities. Whether it's speculative IPOs, high-fee hedge funds, leveraged ETFs, or private equity deals, these products are often sold as a way to boost returns or diversify like the wealthy. Take private equity, for example. It sounds fancy, right? Like something only insiders and billionaires get access to. But in recent years, private equity firms have started opening their doors to everyday investors through different platforms and funds. They promise high returns and exclusive access to private companies before they go public. What they don't highlight? That these investments are incredibly illiquid. You often can't touch your money for 5 to 10 years. The fees are high, the risks are hard to understand, and there's little to no transparency about what's really happening behind the scenes. If the company fails or the fund underperforms, too bad. You're locked in. And the dirtiest part? These products are pushed to people who may not fully understand what they're getting into. Who doesn't fully understand the risk? Many are looking for ways to catch up on retirement savings or replicate the success of high net worth investors. But they end up stuck in risky, complex investments with limited upside and no way out. But the firms and the advisors, they've already made their money. Upfront fees, management charges, and performance bonuses, regardless of how the fund performs. Bottom line, if someone's pitching you a high return investment you don't fully understand, especially with limited access to your money, it's not a strategy, it's a sale. Alright, but let's say that they're not selling you super risky products. All is good, right? Well, sometimes the dirty trick is not what they're trying to sell you, but what they're keeping you away from. The number 7 dirty trick the financial industry loves to play to make more money. Keeping you in the dark about index funds. Index funds are one of the most powerful tools for building long-term wealth, especially for regular individuals like you and I. They're low cost, diversified, and historically outperform most actively managed funds over time. But here's the problem. Many financial firms and advisors don't talk about them because there's little money to be made by promoting them. Instead, they'll overwhelm you with information about exclusive mutual funds, tactical strategies, or some funds with fancy names and a 1.25% management fee. Why is this? Because they often earn commissions or fees for recommending these higher cost products. Meanwhile, an index fund from Vanguard, Fidelity, or Charles Schwab might charge you as little as 0.03%, a fraction of the cost, and no one's getting a kickback for pointing you to it. So they conveniently leave it off the table. You won't hear about how simple and effective it is to invest in something like the S&P 500 or a total market index fund. You won't hear that most active managers fail to beat the market over the long run. And you definitely won't hear that by choosing an index fund and staying the course, you could save tens of thousands of dollars in fees over your lifetime. And it's not a lack of value, it is a lack of incentive. And in my book, that's what makes it so dirty. The number 8 dirty trick the financial industry loves to play to make more money. Insurance products masquerading as investments. You probably heard of the pitch. This is not just a life insurance, it's an investment in your future. Products like whole life, universal life, and variable life insurance are often sold as 2-for-1 deal. They promise you life insurance and investment growth. Sounds efficient, right? But here's the truth. These products are often bloated with fees, confusing terms, and overly optimistic projections. The cash value component is pitched as a savings account or a retirement vehicle. But in reality, the returns are usually mediocre at best, especially after the fees. And those fees, they're quietly eating away at your gains year after year. And what makes the trick so dirty is that it's usually sold to people who don't actually need permanent life insurance. Young families, new parents, or individuals just starting out their financial journey. A simple term life insurance paired with a low-cost index funds will typically give you more coverage and better returns for a fraction of the price. But why don't we hear more about this strategy from the financial industry? It's because there's not much profit in selling term life insurance. They're often cheap and very straightforward. Permanent life insurance products, on the other hand, come with juicy commissions for the salesperson and long-term profit for the company. Whether or not they actually serve your best interests, who cares, right? So next time someone says it's life insurance, but it grows like an investment, just know this. It's probably growing their commission more than your wealth. The number 9 dirty trick the financial industry loves to play to make more money. Conflicted financial advisors. Many people assume that when they sit down with a financial advisor, they're getting unbiased advice from a professional who's legally obligated to help them make the best decisions. But that's not always the case. But here's a trick. A large number of so-called advisors are actually brokers or salespeople who operate under what's called a suitability standard, not a fiduciary standard. That means they're only required to recommend products that are suitable for you, even if there are better, cheaper, more effective options out there. So instead of guiding you towards a low-cost index fund, they might push you into a high-fee mutual fund or an insurance product that earns them a commission. And they won't always disclose that conflict of interest because technically, they don't have to. It's a system built on misaligned incentives. You think you're getting a personalized advice, but you're really being steered towards products that pad their paycheck. And in many cases, you end up paying layers of unnecessary fees that quietly chip away at your long-term returns. So next time you're sitting down with a financial advisor, make sure to ask, are you a fiduciary 100% of the time? If the answer is anything less than a clear yes, I say walk away. The number 10 dirty trick the financial industry loves to play to make more money. Hidden fees. These are one of the biggest silent killers of wealth. Things like 401k administrative fees, account maintenance fees, record-keeping charges, and advisory fees buried inside retirement plans. They don't show up on your monthly statement in big bold letters. Instead, they're tucked away in the plan documents or deducted behind the scenes, quietly eating away at your balance year after year. For example, many 401k plans come with layers of fees. One for managing the plan, another for keeping records, and sometimes even a fee just to access your own account. These might sound small, maybe 0.5% or 1%, but over 30 years, that can cost you tens, even hundreds of thousands of dollars in lost retirement savings. And it doesn't stop there. Some brokerage accounts charge annual maintenance fees, inactivity fees, or custodial fees just for holding your money. Others ding you with trading commissions or service charges when you call to make a change. And the reason this trick works so well is because it's invisible. Most people assume that their retirement or investment accounts are free or low cost, until they dig into fine prints and realize how much is being siphoned off in the background. That's why knowing your fees is just as important, if not more, than knowing your returns. My recommendation is ask questions, review your 401k plan documents, and choose low-fee investment options when available. Because when it comes to building real lasting wealth, it's not just about how much you invest, it's about how much you actually keep. The number 11 dirty trick the financial industry loves to play to make more money. Closing underperforming mutual funds. Essentially, funds that did not beat the market are quietly shut down, merged into other funds, or simply rebranded, while only the winners are kept and heavily marketed. This creates the illusion that the firm consistently produces top-performing funds, when in reality, it's just cherry-picking the survivors. It's a tactic known as survivorship bias, and is incredibly misleading. Let's say a firm launches 20 new mutual funds. Over a few years, 15 of them lag the market. No problem. They simply close those down and promote the remaining 5 that happen to do well. On the surface, it looks like the firm has a strong track record, but behind the scenes, majority of their offerings failed. You just never see those because they've been scrubbed from the history books. This practice inflates performance stats and make investors believe they're buying into a winning strategy, when in reality, they're just seeing the edited highlight reels. It's like our highly edited social media accounts. Closing underperforming funds is one of the most subtle tricks in the book, but very effective at shaping perception. So remember this next time you're faced with a so-called fund that beat the market. Past performance is never a guarantee of future returns, and in many cases, it's not even the full story. Number 12 and final dirty trick the financial industry loves to play to make more money. Complex investments and financial jargon to confuse you. Let's be honest, half the battle in personal finance is just trying to understand what people are talking about. Terms like alpha, beta, standard deviation, Sharpe ratio, contingent deferred sales charge, or synthetic collateralized debt obligation, they're not there to enlighten you, they're there to intimidate you. And it works. The more complex something sounds, the more we assume it must be smart, advanced, and trustworthy. But in reality, that complexity is often just smoke and mirrors, designed to keep you from asking questions. Because if you did ask questions, you might realize that the product being sold to you is expensive, unnecessary, or simply not in your best interest. It's the equivalent of a magician waving one hand in the air while the other is quietly slipping money out of your wallet. The truth is that good financial advice is simple. It's grounded in clear principles. Spend less than you earn, invest consistently in low-cost diversified fund, avoid unnecessary risk, and be patient. You don't need a PhD in finance to build wealth. You just need to understand what you're doing and avoid getting tricked by those who profit off confusion. So the next time someone tries to sell you something wrapped in buzzwords and technical lingo, don't be afraid to stop and say, "Can you explain that in plain English?" If they can't or won't, that's a sign to walk away. Thank you guys for watching the theme of Dirtiest Financial Tricks. If you want to learn some of the worst financial products in the market, please check out my video here. Until next time, all the best.